Well, there's rich and then there's rich. There's rich and liquid, two different things. Rich means that you have assets. Liquid means you have assets you can spend money on today. So if you got a privately traded company, you might be rich, but you don't have millions of dollars or tens of millions of dollars or whatever it is of liquidity. You could have $1 billion. Let's say you own 10% of 𝗏𝗏. You're a billionaire, but you may not necessarily have, even 10% of that to spend on, I don't know, a donation or something like that. Yeah, Byron, that's that's the puzzle. That is the puzzle of finance. What discount rate to use? That is what almost all finance boils down to. What does that mean? Discount rate is one of these things where we just don't know how are we thinking about the risk of a company. Let me show you a quick thing. I got Bloomberg on the other screen. I don't want to show you the evil empire software that we're making a much better version of, but let me show you just this one thing. This is the historical return histogram on Bloomberg. Very few people use this function. I actually updated this function about 15 years ago with my messages to Bloomberg. I am banned from Bloomberg. The thing about Shkreli is Shkreli finds ways around bans, all right? You can't ban the snowman. Can't ban the snowman? Oh, Bloomberg does not like me for a number of reasons. One is I'm trying to compete with them. So the question is, what is beta? Why do we care about beta? Why do we discount cash flows in the first place? All of these questions are really important. We're worrying about risk, right? We're worrying about risk to our cash flows. Here's another function on Bloomberg. I think it's a little newer, called equity risk premium. And the risk-free rate is here, right? I think this is corporate bonds, and then this is the equity risk premium. The beta is the interesting thing here. Do we want to use beta to represent risk? Does that make any sense to you? It doesn't make a lot of sense to me. So like to me, the beta of Adobe, which is kind of like the beta is high beta. Here's I guess this is versus the other S&P constituents. Yeah, pretty sure. Or are these daily changes? Let's see. Okay, no, these are the price movements. This is the one change distribution, percentage changes. So R squared is correlation. Here's low correlation. I'm not sure that beta is the best measurement for risk. I mean, most people don't think it is either, right? This is 52 weeks, it looks like, right? Weekly return. And yeah, so beta is volatility, but it's also, and it's supposed to represent risk. And we use it in Black-Scholes, we use it in equity risk premium. It shows up all over finance. And, basically tries to measure how, if the market's up, how much more or less will the stock be up. But the way I think about cash flows is very different. And I think the way Buffett thinks about it is very different. It's really about like, what is the risk that I'm going to get this or not? It has nothing to do with the stock price, right? You don't use beta in Black-Scholes? Well, you use them in implied vol, right? Maybe we used a different, sort of the same thing in a lot of ways. Maybe we used a different like barrier option valuation model, but you can use Black-Scholes too. So yeah, I think the risk to the actual cash flows is what matters. And some companies have different risks. Like the risk to Adobe is the risk of growth more than it is the risk of downside likelihood. And that's a lot like hedge funds. In hedge funds, the downside vol matters way more than the upside vol. You want asymmetric volatility, right? So you can actually be very high beta and not have downside vol, which is kind of crazy if you think about it. So to me, we were looking at corporate bonds yesterday. I think Adobe is super safe. And we can actually see where their debt trades. Let's see, they don't have too much debt, but let's take a look. They have 2034 bonds. They priced them at 5% a while back. They're trading at 4.3. So the bond is trading at 4.3. Why would we expect to get 7% out of the equity? Shouldn't we expect to get less than that. The bonds, the risk of defaulting in the bond is so low. Now the equity is of course priced a little differently. And one of the things we have to do is just adjust our valuation for different businesses. Like, so if I take the discount rate here, right, and I want to compare it to, well, what are we discounting our Microsoft cash flows by? Let's take a look. 7% as well. Well, Microsoft has a lower discount rate than Adobe, right? Microsoft's a bigger business, it's more diverse. It's really, the risks to its cash flow are very different. So I can't really in good faith say Microsoft should be at 7 and Adobe should be at 7. Adobe should be maybe at 8 if that's the case. Changing the wrong one. And if that's the case, it looks a little overvalued if the growth slows to 7% and then in terminal 1%. It's a bit overvalued. We got to double check cash flow because I think their cash flow is a little higher than this. So maybe it might be that like maybe this represents it a little bit better. But either way, it's not massively different. You have to have a thirst for learning. You know, just learn everything you can. Learn it over and over again. I mean, there are people who got PhDs in chemistry, but you use it or lose it. PhD does not guarantee that you remember things for life. So unless you get constant re-exposure to the subject, getting your PhD does not, or any other degree for that matter, even finishing high school. You remember all the algebra you learned in high school? You got a high school diploma. It just means that at some point you did learn it. Prison was great. I made the most of it. I studied math mostly, a little bit of computer science, biology, of course, kept on top of the pharma industry, made some new friends. Yeah, people want to take the cycle or the cyclical idea and they want to extend it. This is a nice mental model, but it doesn't really work. And it certainly doesn't work on prices. You know, so people tried to distort and make the cycle concept work for crypto. So crypto has had this thing where, I don't know if you chart Bitcoin. Let's see if we can chart Bitcoin. And I like Bitcoin. So this is 08. I don't know. Let's see if we could do this every 4 years. Is that okay? So Bitcoin is more or less, I mean, I can pull up the chart, obviously. This is 0. It's more or less done something like this, right? And that looks like a cycle. It sort of feels like, okay, here's a pattern. But there's nothing that says the next thing that happens isn't that. And it just stays down here forever, right? And there's nothing that says that this can't happen. It goes up and we never see a cycle again. So anyway, the idea of the cycle doesn't really apply here. There's the halvening, which doesn't really make much of a difference, but we're tempted to think, okay, X happened, Y happened, X happened, Y happened, X happened, Y happened. Next time X happens, Y is going to happen, right? But this is just Pavlovian. Pavlov, you're not a dog like Pavlov, right? Anything could happen in markets, anything. Like I said, we could have it down 99% and stays there forever, or up 1,000% and stays up forever. There's no real reasoning that says that it has to go up or it doesn't. In fact, the opposite is true, right? If you knew something was going to happen in the future, you could predict it today. So if you think a software company is like 0 risk to the cash flows disappearing, I think you could discount as low as close to risk-free rate. Because at the end of the day, what matters is the realized risk. All this stuff is imaginary. It's kind of like math. In math, you play with these different objects that are just made in your mind. They're not real. You can't touch a manifold or, you know, cut the real numbers with a scissor. They're just imaginary. Discount rate is the same. We're discounting next year's cash flow and the year after. But when that time comes, you know, basically you either get the money or you don't. Yeah, I have a bit of a nervous energy. I mean, one of my favorite techniques is, as you guys can see, you set the NPV, solve for the market cap right now, and say, okay, this is what would have to happen. They would have to grow 10% until 2030, and then grow cash flow 1%. So they're growing revenue 10% to be clear, and then grow earnings 1% forever thereafter. They have to return 3% on their money, and an 8% discount rate, that's the current NPV. Is that cheap or not? Will they beat that or not? That doesn't sound that far from, that doesn't sound conservative. I mean, to go up 10% every year for the next 6 years, not easy. We don't know that they'll do that. And then the 1% at maturity, I don't know what'll happen there, but some people are saying there's the software, we're going to see the end of the software industry and stuff like that. So even if they just grow a small amount, the stock gets cut in half. And obviously it's not clear that they can grow 20% ever again. That's the only way you can double your money. It's pretty good pass, or even maybe a short. But again, management's really good, and that's kind of the X factor in every stock. And you can sort of quantify that with these ratios. You can say, well, maybe the growth's not going to be great, but I really believe in management. Management's going to make really good investments. So the return on their capital that they invest is going to be 20%. They're going to make great acquisitions. Then the core business doesn't have to grow. The new deals take care of itself. So you really have to sense management and say, okay, I think management's really good. That's why I put these, and I want to compare them against other companies. So if I say the ROIC for Adobe is 3%, but Microsoft is 6%, I think Microsoft's going to earn 6% on its money because Microsoft does great deals like Activision, or they make great investments. Most of these S&P 500 companies, they're not, in fact, most companies in general in corporate America, they're not going for broke with their balance sheet. They're very conservative. Yeah, but there are definitely changes afoot in the creative space. Midjourney is a good example. And Adobe's like the low-hanging fruit, like PyTorch is very natively like adjusts photos, where you can represent photos and tensors very easily, whereas things like CAD are a little different. There's affinity, you said. Yeah, current bond rates are a good example, but the most important thing on discount rates is comparing them to other companies in the industry. So if you set your Adobe discount rate to 8 and you have your Microsoft discount rate at 7, you have to adjust to see, okay, is Adobe a little more risky than Microsoft, or is it more deserve a 9 or a 10? So it doesn't actually matter what the percentage is. The differential is what matters. Look at Micron. So in cyclical downturns, the gross margin is negative. All right, do you see that, chat? So I'm talking about gross margins negative, meaning it costs money to make their product more than they sell it for. You might say, why not just throw the product away? Well, hold on. What is cost of goods sold, chat? I'm going to teach you something. What goes into cost of goods sold? You're making DRAM. What is this line? What is it? You guys know? Maybe ask ChatGPT. How do you make DRAM? It says crushed berries. Okay, you know what? Google is not so great. I'm going to ask ChatGPT. Okay, you do need a wafer. You need to oxidize it. You need to use lithography with a photoresist layer. Is that a mask? You need to etch. You need to dope. You need to form capacitors. Is that a separate process? And then you do all this other stuff. Clean room environment, etc., etc. Not easy. So is silicon the main ingredient, if you will? Yeah, silicon is the primary material, which is the substrate for semiconductors. Price can range based on purity, market demand, and the form. High purity silicon wafers can cost anywhere from $10 to several $100s a wafer. Interesting. Sounds like the wafer is pretty cheap and the process is the expensive part, or both? You're correct. The wafer itself is relatively inexpensive compared to the overall cost of the process. The wafers can be affordable, but the complex steps require expensive equipment and significant labor. So what goes into the COGS? Is this all wafers? What do you think, chat? So what's in here? Wafers, labor, Emmanuel says labor, great. Anything else? Electricity. Machines, thank you, Alex. That is the question. How do we recognize these? Because look at these quarters, right? If it cost me 4.4 billion to sell 4 billion of chips, I'm just not going to sell the chips, right? Why lose extra money? So machines are depreciated. And depending on that depreciation, these COGS could kind of not really reflect the true economic gross margin, right? The actual gross margin net of machines might be positive. That's the point. Do you get that? The machines you buy once, but you depreciate them over time. So they might actually have positive gross margins, but because you have to expense the machines a certain way, that's sort of the issue. So here you have GAAP, non-GAAP over here. I think in non-GAAP, they basically are, as always, they're making adjustments, but it's not clear. Well, you know what we can do is we can look at gross margins. I'm sorry, we can look at cash flow from operations. Micron was a small company way back when. Come a long way, dog. All right, so let's look at cash flow from operations because that's going to be pretty important. So on the net income side, they lost 1.3 billion. This is the best accounting lesson you could take. You really want to understand accounting, look at Micron. Net income, GAAP net income, negative 1.3 billion, right? That's from our model. Their reporting was negative 1.2, so we're pretty close, about 30 million off. So what makes the difference? Well, let's add back depreciation. That's the main difference. And what do we have? The loss goes to a profit. It goes from 1.2 in losses to 1.3 in gains. That's positive $1 billion. And that all came from depreciation. So we can actually do something even crazier here. We can do almost like a separate line item if we wanted. I've never done this before, but let's try it this way. Let's do depreciation. And then let's do gross profit plus depreciation. And let's do gross margin. I'll put these in like this. So now you can see that excluding the machines, if you exclude the machines, the gross margin was 40%, which is why they're willing to sell the chips on the income statement. It looks like they're willing to sell the chips for a loss, which no company would do that. You'd rather burn the chips, right? Throw them away. Yeah, I don't think you could do much with the equipment when it's gone. It's pretty much useless at that point. Yeah. So that's the big difference here. Why ain't it 1401? Oh, okay. There's a separate, okay, there we go. And so now you have CapEx. The problem with this is that he spent 1.8 billion on CapEx. You're back in sort of this negative territory. Let's see if we add that back. You can do it negative, positive, doesn't matter, however you see fit. Yeah, it's a good question, Chetan. I generally try to normalize margins. So what I'll do is I'll remove extraneous costs that I think are one-time or speculative spending. So like for Facebook, you should just delete all R&D that corresponds to their Reality Labs product. Because if you're not going to count the revenue coming from it, you shouldn't count the costs. That's advanced, Shkreli modeling. That's only for the realist. It's like 201 instead of 101. Yeah, this is a big space. The ocular space is a big space. So that's one of the other weird things. as I hope I gave you something to think about on the PE ratio, like what happens if a company's earnings are negative? Can you apply a PE ratio to that? The same thing applies here where we're trying to figure out, do you think the stock price correlates with the boom and bust of the revenue? Do you think that the stock price goes up and down with the revenue? And why or why not? You would think that that's got to happen, right? At least to some extent. Not necessarily. It's really kind of a mind trip that the company's earnings can decline from positive to negative and the stock can actually go up. You know, if you're taught the real simple PE ratio stuff, you really lose out on understanding what business is all about. So of course earnings are important and of course growth is important, but it's not everything. When you're judging a stock price, it's really a completely different thing, isn't it? So let's take a look at gross margins over time. Positive 38, positive 45, negative 9. Boom, bust. In the bust, you just hope to not lose everything, right? 1, 9, 1, 22, 8, 31. Okay, there's earnings per share. Same thing as net income, just okay, so what can cause a business to go, I want you to think about this, to go from 6 or 7 billion in net income, then 8 or 9 in net income, billion in net income, then negative 6. And how do we know that negative 6 is going to be negative 14 next year? The conditions of the industry, very, very brutal, and they change quickly. But this is just a small picture. Some people call this cyclical growth. That even though there are these business cycles, and that's where the term really comes from. I hate it when people use the term in crypto. Ugh, really pisses me off. Because there's no real cycle in crypto. There's a cycle in DRAM because there's supply and demand. And the supply and demand lags each other. The term is cycle. Yeah, exactly, Elmer. So I'm going to draw supply, and well, I'm going to sort of draw demand in green, okay? So demand will go up, you know, maybe a new chip comes out. And here's what will end up happening. Supply is sort of lagging. Supply sees the demand going up, and they catch up. But in this period, we call this a shortage, right? Supply hasn't caught up to demand. But supply will continue, and demand might even start to tail off. And supply doesn't realize this for a while, and this we call a glut, right? By the time we're out of the recession or the glut, demand is back, and supply is still confused as to what to do. Maybe supply is a little more conservative this time because it got beat last time. So that's business cycles. NVIDIA is a very interesting question about, will NVIDIA hit the same thing happening? The problem is with NVIDIA is that they control the supply. A lot of times in DRAM, the actions are based on your competitors. It's a collective action of many players. The red line is many different companies, many firms deciding together. In the case of NVIDIA, it's just them. So the industry's really, kind of pegged to them. Yeah, Ed taught me value investing, at least his brand of it. Ed had a great joke. He said, what is the definition of book value? And of course I would say something like, and nerd me, 18, 19 years old, would be like, well, book value is assets minus liabilities, except if you're talking about tangible book value or we exclude goodwill. And he goes, no. Definition of book value is that's the most amount of money you would pay for a stock. And I laughed. Good value investor joke. Investing in general is very painful. It's an emotional roller coaster that's not for everyone. it's very hard to stay calm during investing. It's very hard to, there's a great book about it called Trading to Win by 𝗍𝗂𝗍𝗂. And if you read that book, you might take the first step in that journey. You have to learn to listen to your emotions, not just blunt them, but listen to them. It can work really well, but the thing about trading that's very difficult is you have to be right all the time. And you could be on a very hot streak where you feel like you're getting every trade right, but then if you turn cold, you have to buckle down and avoid risks very quickly. That part is hard. That's the hardest part. But what's hard for me might be different for you. Bliss, I made a 20 million bucks shorting something. That's not even institutional, that's just personal. I think that you should be more stressed when you are trading or losing money. It's weird if you're taking a big loss and you're not feeling anything. I think that's strange, kind of bizarre. You should probably be feeling something. I lost 100 mil just to feel something. That's not a good idea. It's like that song, I put my hand on the stove. I put my hand on the stove. Yeah, you gotta manage drawdowns. I never really did well managing money for others. Did very well managing money for myself. Managing money for others is very hard. I don't wish it on anyone. It's like very stressful. Yeah, no, I've definitely blown up accounts. First time was when I was like 19, I would say. I'd gotten my personal trading account up to quite a lot, and I bet it all on this weird merger arb trade. And it was a great learning experience, to say the least. I wish I didn't have it, but
that's one of the most like advanced and misunderstood things about stocks. Maybe I should make a video about it. It's probably going to sail over everybody's head. But like when you look at your portfolio, and if you could emulate your portfolio without using the stocks in your portfolio, you're not really investing in those stocks. You're investing in a bunch of other factors that will give you the same return. So if you own Carvana, if you own stuff like that, really high growth meme stocks that are kind of being shorted or stuff like that, like you're basically just buying a bunch of beta. Like if you own, maybe a better example, if you own NVIDIA and then you own, what's like a super high beta stock, Palantir, what else is super high beta? Eli Lilly maybe. Lilly's kind of a defensive company, but it's sort of high beta just because of what they do now. But they're probably not the best one to look at. So it's like one basket. And then if you own Boeing and Alibaba and all these other beat up value stocks, Intel, right? That's a totally different portfolio. And you could basically buy a value index and get the same result. Basically is like, depending on your sizing and stuff like that. Obviously, if you have 3 positions and they're 33% each, you're getting idiosyncratic risk. But if your portfolio looks all the same,